Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael Seeding. This is a few final thoughts on Atlas Copco. We left off with the Kagran conclusions that 8% total annual return, so 6% annual growth for the share and just 2% additional dividends, so a total of 8% per year. That is definitely not enough to warrant an investment in a market type of risk stock. As I usually say, you should require at least 12.5% per year, or even 15%. It depends a little bit, of course, on the type of stock. Atlas Copco being such an important stock in Sweden will always have their fan base. Fans like the Wallenberg family and the big funds and even international funds will keep investing in this very heavyweight index stock. So they will always be a little bit overvalued, and you can actually count on that. However, they already are pretty steeply valued, and unless they can grow faster than at least 10% per year, if they can't grow sales by more than 10% per year or earnings by more than 10% per year, then even just keeping the high valuation level would only give you that growth 10% plus the dividend, let's say 2%, for a total of 12%. That would make it more or less fairly valued. But as you could also see, is that consensus is a little bit cautious here and not expecting that type of 10% annual growth, but rather 6 to 8%, making it not that good an investment prospect. However, it seems Atlas has over 100 years of history. They tend to come up with new avenues of growth, new ways of surprising the market. They have these recurring bouts of a plunging share price, but not for very long. And then they recapture their exponential trend, making it a really good investment over time. It's hard to say exactly how they do it, but let's look for a few clues to this outperformance. So one here is that they have pretty good margins and pretty stable margins as well. Even at the worst of times, they don't even go below 23%, and their peak years are at around 25% over the last 5 years. And that's despite all the challenges that we have touched upon earlier in earlier videos. And if we look at their net income margins, just look at this stability here between 16.2 and 16.8% in net income margins. This is almost wizard level stuff from Atlas Copco. And also going even all the way to their book equity and their return on equity numbers. These are absolutely stellar numbers, with 30% return on equity, sometimes touching 35% and never really going below 25%. Remember, with the rule of 72, that if you grow by 25% per year, then you double in 3 years, you 4x in 6 years. That means that if you have a certain book equity today, just 6 years later, you would have 4 times that book, and add another 3 years and you will double again to 8 times that book. So your book equity will go from 1 to 8 over those three-year periods, so over 9 years. That means that if you pay 9 times book equity today, it's the same thing as paying just 1 times book equity 9 years into the future. Sure, you will have lost 9 years of investing time, but after that 9 years, you would have like this super growth company that again, if they can keep these 25% per year, will grow to 9x over the coming 9 years. So this is the magic of having a high return on equity, and this is actually what propelled Amazon from just a small dot-com startup to the behemoth it is today. If we look at Atlas Copco's price to book, I mean it's just at 6 times its book equity, and they should, given their historical numbers, actually grow by 9x over 9 years, making them really, really cheap at the end of that period. This high return on equity, which enables them to pay dividends, to invest in growth, to find new growth avenues, to maintain their quality lead and their high margins, and that also in the end also means retaining their high return on equity numbers. This might be what lies behind both this pretty compelling long-term stock price chart and their, in a way, kind of rich valuation levels that you can't really explain in terms of sales growth and earnings growth, and absolutely not from the projections that analysts are making. But just looking at the 35-year stock price chart, you see that these negative plunges in the stock price, they're always pretty soon recaptured, and that goes for COVID and the 2022 disappointing years with inflation and other negative developments, not least in Ukraine and geopolitics in general. And now recently we had one more of these where the stock price fell from 180 down to 116. We're now almost half back up at 142, but just a few days or weeks ago at 116, well, that might have been it. That might have been the opportunity you had to get in on this weather vane for actually both the global and the Swedish economy. It's still not cheap at current levels, 142, but there are reasons to believe that the formula that took them to where they are, to the spot number 1 in Sweden, and the underlying reasons for creating this chart formation with corrections and then recapturing very bullish periods for the stock, and in the end giving investors definitely a decent return and decent return on their money for investing in this stock. There's something going on here that is definitely worth a closer look, and not the least creating price alarms. So if we could get down to 116, then maybe we can actually get down there once more during let's say the coming year, if we have a recession, if the tariffs wars start again. I would not dare hoping for the stock to come all the way down here to, let's say, 80, but at 80 I think this would be an excellent addition to a long-term portfolio. I cannot see that Atlas Copco will lose their very strong global market position in their industry. However, I think that it might be hoping for too much to actually get it at 80, and already at 100 it would be a bargain, I think. At 116 a few weeks ago, it's not really a bargain, but it's a good deal, and it's a solid part of a long-term equity portfolio. So this is not something that will make you rich in the short to the midterm, but it's definitely one to keep track on and set price alarms at 115, for example, to begin with.